Imagine a neighbor asks for a favor. They want to borrow 2,600 rupees. Instead of a normal loan, they offer a unique deal. You hand them the cash today, and exactly 8 years from now, they will pay you back whatever the market price of 1 gram of gold happens to be on that specific day. You assume gold prices are fairly stable, so you agree. This chart shows what happens over the next decade. Fast forward 8 years. That single gram of gold is now worth 14,400 rupees. Your neighbor's personal debt ballooned by 400%, simply because the market price of a metal went up. This isn't just a story about a bad deal between friends. This is exactly the deal the government of India made with millions of its own citizens. Attaching a simple cash loan to the price of a global commodity removes the usual certainty of borrowing. You no longer know exactly what you will owe in the future. It turns a standard government bond into a high-stakes financial gamble. The story begins back in 2015. At the time, Indian citizens were buying massive amounts of physical gold from overseas. This drained the country's foreign currency reserves and put heavy pressure on the national economy. To stop people from importing physical gold, the government launched the Sovereign Gold Bond Scheme. The official terms attracted small savers and large trusts. The bond tracked the price of gold perfectly, and the government paid a guaranteed 2.5% interest annually. Plus, if you held it for 8 years, your profits were completely tax-free. Millions of people signed up. Over the next 8 years, the government released 67 different batches of these bonds, successfully collecting over 72,000 crore rupees from the public. When the scheme launched, gold was trading between $1,100 and $1,500 an ounce. The math of the plan worked best if those global prices stayed within that general range over the next decade. By offering paper bonds, the government solved the immediate problem of physical gold imports, but they also created a massive, unhedged bill for the future, one that grew every time the price of gold ticked upward. This diagram compares the 72,274 crore rupees collected against what is owed right now. The estimated payout is roughly 1.87 lakh crore rupees. That creates a 1.15 lakh crore rupee gap the government must pay, purely because gold surged. The original plan included a safety net. They legally established something called the Gold Reserve Fund. The entire purpose of this dedicated savings account was to absorb the shock if gold prices ever spiked. Today, that safety net is practically empty. The Gold Reserve Fund currently holds less than 0.4% of the money needed to cover the current gold price. The massive financial cushion required to protect the Treasury simply isn't there. The national debt from this program grew by 2.6 times, while its dedicated safety net shrank to nearly zero. When the money owed vastly outpaces the money saved to pay it, a future cash flow crisis becomes a mathematical certainty. You might wonder why this massive financial gap isn't a bigger topic of debate. The answer lies in cash basis accounting. This system records the cash the government actually received years ago, but it doesn't show the ballooning future cost of the gold they promised to pay back. This situation is further hidden by how the Reserve Bank of India manages its massive stockpiles of physical gold in domestic vaults. As gold prices rise around the world, the paper value of the central bank's gold increases as well. The RBI records this increased value as a profit and pays a record-breaking dividend directly to the government. The government then counts that dividend as regular income, which makes the national fiscal deficit look much healthier on paper. But here is the catch. The exact same rising gold price that creates the central bank's profit is also inflating the government's bond debt. When the budget is presented, only the profit side of the equation is visible. The debt stays in the dark. Using paper profits from the central bank's vaults to mask the real cash cost of gold-linked debt creates a fiscal illusion. Everything looks manageable on the surface, right up until the day those millions of investors finally arrive to ask for their cash. There is also a structural conflict of interest at play. The government owes billions based on the domestic price of gold, but the government is also the entity that sets the import taxes, which directly control that price. In July 2024, the government slashed taxes on imported gold. They did this just 13 days before a massive batch of gold bonds matured. Because the taxes dropped, the domestic price of gold fell, which lowered the amount the government had to pay out to investors. saving the Treasury roughly 620 crore rupees on that single batch. But domestic tax adjustments cannot change the global market. Central banks worldwide, especially in China, have begun hoarding physical gold at record levels. This massive demand has shifted the baseline price of gold much higher than anyone anticipated in 2015. Global geopolitical shifts have changed how countries manage their wealth. Even the Reserve Bank of India is quietly moving its physical gold out of foreign locations and bringing it back to secure domestic vaults. By issuing these bonds, the government took a massive short position on gold. But as the world moved to buy more of the metal, that debt became a massive, unhedged fixture on the national balance sheet. As these costs grew, the Ministry of Finance changed its strategy. They have recently suspended the issuance of any new sovereign gold bonds, noting that other forms of government borrowing have now become more cost-effective. But the bonds already in the hands of the public aren't going away. A massive wave of redemptions is scheduled to hit between 2026 and 2032, as the remaining batches finally reach their 8-year maturity dates. With the gold reserve fund nearly empty and the debt compounding, a simple question remains: where will the actual cash come from? The hundreds of thousands of crores required to pay off these investors will not come out of thin air. That money will have to be directed directly from general taxpayer revenues. What began as a policy to formalize savings resulted in some early investors seeing nominal returns of over 300%. While it met the goal of shifting people away from physical gold, it also left an unhedged bill for future generations of taxpayers to pay.